Right now, 90% of retail traders are losing money. They buy the top, panic sell the bottom, and get absolutely crushed by the market. You know the feeling. You buy into a breakout because everyone on social media is screaming that a stock is going to the moon, only to watch your portfolio bleed out hours later. Most traders fall into this cycle because they rely on lagging indicators, mathematical formulas like RSI and moving averages that only calculate past price action. They are staring at the smoke and completely missing the fire. In the late 1800s, a journalist realized that market movements weren't random, but followed a set of repeatable human behaviors. He codified these observations into Dow Theory, a framework that established the core principles of technical analysis still taught to professional analysts today. Smart money uses this system to identify where the crowd is most vulnerable. They wait for a very specific Phase 3 signal in the market, a trigger that tells them to exit before the momentum collapses. If you don't understand how this foundational blueprint works, you are the bait. Learning these rules is the only way to stop handing your capital over to larger institutions. Charles Dow spent his career analyzing price behavior, eventually co-founding the Wall Street Journal. He realized the market doesn't move randomly. It reflects our collective psychology. By 1929, the market reached total euphoria. Everyday workers and taxi drivers passed out stock tips on street corners, convinced prices would only go up. Then, the floor fell out. Millions lost their savings in a matter of days. But a handful of traders survived because they stopped listening to news and started reading the market's actual structure. They followed Dow's first law: the market discounts everything. This means that every earnings report, rumor, and piece of economic data is already reflected in the price before you read about it in a headline. Dow's second law states that markets move in 3 distinct trends: the multi-year primary trend, shorter secondary corrections, and daily minor noise. A trend remains in effect until clear, structural evidence proves it has reversed. While the assets we trade have modernized, the underlying human emotions remain the same. Because these patterns repeat, Dow's century-old rules provide a reliable framework for reading modern market psychology. Every primary bull market follows a 3-phase cycle. Understanding where you are in this sequence is how you identify when a trend is reaching its limit. In Phase 1, accumulation, institutions quietly buy at the bottom while retail panics. In Phase 2, public participation, the asset breaks out and retail aggressively buys through FOMO. In Phase 3, distribution, the peak flattens. Institutions sell their shares back to the excited crowd. Look at the volume and sentiment in the market today. Which of these 3 phases does the current price action suggest we are in? Recognizing these phases means you stop acting with the emotional majority. You anticipate where smart money moves instead of reacting after it's too late. Dow defined a healthy uptrend as a series of higher highs and higher lows. The specific moment to watch is when the market fails to make a new high. That structural break is your first sign that the trend is exhausted. To avoid fakeouts, traders look to Dow's principle of confirmation, the requirement that major market averages must move in sync to validate a trend. In Dow's he measured economic health by tracking industrial plants. If these plants were busy producing goods, it signaled the economy was expanding. But those goods had to be shipped. Dow knew a surge in industrial production had to be confirmed by the transportation companies moving that freight. If industrials rose but transports lagged, it signaled that the demand wasn't real. Today, traders apply this by comparing indices. If the S&P 500 makes a new high, but the Nasdaq refuses to follow, the trend lacks confirmation. If price moves up while buying volume drops, the market is signaling a lack of genuine participation. The market is a system designed to transfer capital from emotional participants to disciplined ones. Mastering Dow Theory provides the structural discipline needed to protect your account from the common cycles of retail panic. If you want to trade with the smart money, smash the like button and subscribe for more institutional level breakdowns. Drop a comment below with the word Dow and tell me, are modern markets driven more by raw fundamentals or by human emotion? Stay disciplined, and I'll see you in the next one.